So in the past 12 months, I've received many negative comments about the 401k and how they believe it's just a scam. So I put together some comments from my videos for you to see, and I love to hear your thoughts on them. And I'm not by any means trying to dismiss or make fun of these comments because they actually have some good and valid points about the negative side of the 401k. And this is coming from someone who is a big proponent of the 401k, Roth IRA, and other investment vehicles because I am, like many of you watching this video, the living proof of how disciplined investing can take us much further than everyone else. And I am fired up to talk about this because I want you to see your 401k investments from a different perspective. Just because I disagree with someone doesn't mean I can't be friends with them, right?
You weren't anyone's friend.
The first person said, it would be a great benefit to the working class if we did away with this 401k garbage and brought back pensions. And the other person replied, said 401ks are a scam introduced by the Republicans in the 80s and killed pensions and shifted costs from employers to employees. The next comment said, I have some aggressive opinions about retirement plans in general, pensions, 401k, TSP, etc. In short, I believe there are scams and some of the worst financial advice. You cannot save yourself to retirement, and I don't think saving in those sort of vehicles is a sound retirement plan. And the next comment I got is, you forgot one thing the manager of your 401k does not have to have your best interest anymore. They can put it in anything and you lose everything, and there's nothing you can do about it because they do not work for you anymore. 401ks are becoming a scam. Now, I am not here to bash these comments because there are some significant downsides to a 401k. And I know people are often frustrated with different rules and regulations with the 401k, which is why I created this YouTube channel so that you can get free financial education. So feel free to share this video with your friends and family and subscribe if you haven't done that already. Let's first talk about the pension fund from the first comment. Are pension plans better than the 401k? Let's do some comparisons. And there are different types of pension plans. To simplify the explanation, I'm just going to go over the traditional pension or defined benefit plan. And that's really rare now, but they still exist in the private and mostly in public sectors. And they contributed roughly 7% of my income to my pension plan every year, which was extremely generous. I didn't have to contribute anything out of my salary at the time. And in order for me to gain access to that pension fund, I had to work for my employer for at least 5 years to be fully vested. And that is a pretty general rule for most employers with pensions. And I also got an annual report from the pension plan about how the pension fund is doing. I didn't have any control over how the pensions were invested because those were managed by pension fund managers. And I knew they were growing at an average of 3% increase every year. So they were invested in more secure investments rather than aggressive investment funds. So why are companies in the private sector abandoning pension funds? The reason is simple. It is too expensive to pay their employees for their entire lives. And that guy in the first comment is right. Section 401k came out in the 1980s to slowly replace the pension fund to take employees' pensions off their balance sheets. Many of us in the millennial generation and beyond probably won't get to see any pensions in our lifetime unless we work for the public sector or a private sector job that provides a pension. And the private companies that still have pensions have the right to suspend or end the pension plan altogether if they go through a long-term economic headwind. What happens when companies start to lose their net profit? One of the first expense lines they're going to cut is labor, because people are the most expensive line item on any company's balance sheet, right? And I'm not trying to sound insensitive, but that is the reality. And 3M, the company that made all those COVID masks, just announced that they're going to suspend their employee pension plan. You can check it out on the Wall Street Journal. And I'm going to make a separate video about that in the future, so be sure to subscribe if you haven't done that already. But it's a lot tougher for the government sector jobs to suspend or end the pension fund because most of them, if not all, are congressionally mandated or state mandated. It doesn't mean that they won't ever disappear because it did happen during the 2008 global recession, but it's a lot tougher to be in that situation than in the private sector. The public sector jobs that still pay pensions for their employees are teachers, state and local government employees, first responders like firefighters and police officers, registered nurses, military members, and federal government employees. I served in the Air Force and I will collect my military pension as a reservist. My wife works for the state and has an incredible one-to-one pension match, and most of my clients will receive some sort of pension for working for the federal government or as first responders. And if you insist on working for an employer that gives you a pension fund, working in the public sector might work out better for you. They don't just come with a pension plan, but they also come with a 403b or 457b plan that is similar to the 401k. And you can always schedule a complimentary session with me by visiting firestation.com/coaching if you want to talk about your retirement plan. Let's just say that you don't have a choice but to invest in a 401k with the employer you currently have. What can you do? Is it a scam? And I wouldn't call anything a scam just because I disagree with it. And I think there are people who disagree with the fact that employees have to be the ones who contribute to their 401k and not their employers. And how a 401k works is you get to deduct directly from your paycheck and contribute to your 401k in either pre-tax dollars or post-tax dollars. Some employers will allow you to do what's called a mega backdoor Roth or the after-tax contribution, but that's going to be a topic for another day. So if you do the traditional 401k, then you get to reduce your taxable income now, but you'll end up paying taxes later when you retire. If you do the Roth 401k, then you pay your taxes now so that you can enjoy tax-free distributions later. And many employers will do a match to your 401k if you contribute up to a certain percentage. I always treat my employer match as a bonus. For example, a company could have a rule where you have to contribute at least 5% of your income in order to receive the 100% match up to your 5%. So if I make $50,000 a year and my employer contributes 100% of my 5% contribution rate, that's an extra $2,500 going into my 401k. With the new 401k laws, you have the option to pay taxes now or later with the employer match. And the money you and your employer contribute will go into the 401k core fund. From there, you get to choose limited and pre-selected mutual funds your employer and your 401k plan has an agreement with. And most of the time, when you start working for your employer, your 401k plan provider will automatically allocate your money inside your 401k account. This is actually a problem for many people because the person who allocates your 401k doesn't know your risk tolerance and financial goals. They don't know if the S&P 500 index, fixed income mutual fund, or how much of the international mutual fund should be made up in your portfolio. Our government and your employer can't teach you any of this because it's not their focus area. Many of you may not understand or feel comfortable with the risk and uncertainty of investing. You might be fearful that if you choose the wrong mutual fund, you're not going to be able to retire on time. Trust me, I had the same feeling when I started investing many years ago. By the way, did you know that almost 30% of Americans don't budget? Guys, whether you make $50,000 a year or $200,000 a year, the very first step of your financial independence journey is to create a budget. So I am so excited to announce my partnership with YNAB. YNAB is not just a budgeting app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. Budgeting doesn't need to be stressful when you become intentional with your savings and spending. As a financial coach, I always recommend you give every dollar a job, and YNAB can help you do just that. So if you want to get out of the paycheck to paycheck cycle, get started with YNAB using the link in the description below and start your free trial now. So here's some things that I really want you to focus on when it comes to 401k investing. I'm going to show you some examples later on so you can see how I do my basic research on a mutual fund. I'm not going to get into any fundamental or technical analysis in this video. The first one is to understand the purpose of the mutual fund and its performance. The purpose of this mutual fund could be capital growth, which means that it's trying to grow its share price over time. The purpose of another mutual fund could be fixed income, which means that the share price doesn't grow as much, but it will pay you dividends. You need to check the mutual fund performances and see how well or how bad they have performed over the last 5 or 10 years. You also need to know if this mutual fund is actively managed or passively managed. An actively managed mutual fund means that there's a group of portfolio managers who actively buy and sell stocks inside that mutual fund to try to beat the market. A passively managed mutual fund means that it is just following the market trend. It's not trying to beat the market, it's just going with the flow. And every mutual fund comes with a cost, and some are expensive and some are very cheap. Warren Buffett even said that you have to pay very close attention to the cost of investing because it can eat into your profit. An actively managed mutual fund could cost you 10 to 20 times more than a passively managed mutual fund. Is it always wrong to invest in an actively mutual fund? Not necessarily. Some mutual funds managers are really good at what they do, but the historical records show that only 26% of active mutual funds outperform index funds in the past 10 years. It became an easy choice for most retail investors to choose index funds for their costs and performances. And the big downside of having a 401k is probably the fact that we have to pay an additional fee for having a 401k. This is where I would agree with the guy who commented on my video that 401ks don't have to have your best interest anymore. When I was with my previous employer, Vanguard charged me about 0.75% in annual fees back in the days. So not only did I get charged for investing in a mutual fund inside my 401k, but I also got charged for having a 401k. This is truly the big downside of having a 401k because I could have a 10% return in a year, but 1 and 2% of that could go to the management and administrative fees. And the other downside is how the 401k automatically allocates your investments between stocks and bonds. If you don't log in there and make the changes yourself, the 401k portfolio manager will put some of your money in fixed income assets, international stocks, long-term bonds, and the S&P 500. A lot of times, they'll just throw your money into the target date retirement fund that will automatically make allocation changes every year. The problem with letting them manage your 401k is that they're not taking your risk tolerance and long-term time horizon into consideration. So a lot of people are complaining that their 401ks are underperforming the market, and this is probably why. Some of the allocations are way too conservative based on your current age. And I want to give you a quick tutorial on what you can look for when you research mutual funds inside your 401k. So the first one I want to go over, this is probably one of the most common index fund, which is the S&P 500 Index Admiral Shares. So this is 401ks are all mutual funds, okay? It's very rare that you get to find ETFs unless you're doing a self-directed 401k like I do. It tells you if this is a actively managed or passively managed. So right here, if it says management style, it says index, that means it's passively managed. And the other way to know about it is the expense ratio is 0.04%. So you can calculate that how cheap it is to invest in a S&P 500. And I'm going to show you the other mutual fund in a little bit. But what it tells you is the net asset value price, that's what NAV stands for, is $438.91. So it was based on January 9th, and it's always a day behind because they don't process the orders, the buy and sell until after the market closes. That is the difference between mutual funds and ETFs and individual stocks. You can always trade ETFs and individual stocks when the market's open. Mutual funds get processed after the market closes. But how you look at it is basically the S&P 500 is a large blend, and you can look at the price. It is currently trading at $438.91. And when you go into the performances and fees, you can always look at what the year-to-date performances are. This is not updated, I don't believe, but this is based on the 2023 prices. Yes, this is from December 31st. So let me go ahead and go to the quarterly. So this is still not updated for 2024. So when you look at the chart here, right, it can be a little bit confusing, but what you really need to look for is, for the last 5 years, starting today, back to 5 years, it has performed 15.65% average annually, okay? I know 2022 didn't make a 15% return, but if you average the last 5 years, it's 15.65%. Now, for 10 years is what I really pay attention to. That is almost 12%. That is on average return 12% annually, okay? Now, a lot of people misunderstand about the differences between 1 year and year to date. 1 year means today from last year, okay? So that is 365 days from last year. Year to date is from January 1st, 2024, not from a year back. So year to date return right now, you could be seeing 1% or 2% down. You don't need to panic on that. That is just based on the trading days for the last 10 days into the calendar year. But that's what it means when you look at the performances and risks. If you scroll down, you can look at the charts and tables. And if you invested, say $1,000 from 2019, this is how much money it's going to grow in 10 years. It tells you that. It's pretty simple. The other thing you can look at is number of stocks in this mutual fund. It has 505 in VFIAX or S&P 500 index fund. And benchmark would be the S&P 500 benchmark. If you scroll down, it's going to tell you what the VFIAX is, what sectors they have. They're very diversified between communication services, communication discretionary, energy, financials, technologies. And if you scroll down, it's going to tell you what the top 10 holdings are going to be. That's how you will look at it and know how much you're paying for investing in this S&P 500 index fund. And the other example, and this was a question I had from my private client program, is that, hey, I have this in my 401k, and this is a very, very common 401k mutual fund. What does American Funds EuroPacific Growth Fund Class R6? Most people will see this in their Vanguard or maybe in their 401k, okay? It doesn't mean that you're investing in the United States or US stocks. It is actually international funds. American Funds is just the name of the company. It is a broker that manages the mutual fund. EuroPacific, that is what they're concentrating in. The European stocks and the Pacific stocks. That would be Asia, Australia, and all that. But what you really need to do is actually just Google this. The ticker symbol would be RERGX. And then when you Google this and then go to Vanguard, Fidelity, or whatnot, it tells you what the product summary is, okay? It primarily focuses on the growth of capital and goes in Europe, Pacific, Asia, Australia. They do focus on the emerging markets. So what that means, emerging markets means that the smaller companies or medium-sized companies overseas that are looking to grow over the next 5 to 10 years. It is a very speculative company that they're investing in. So how do we know if this is passively managed or actively managed? This is a actively managed fund that is managed by American Funds. And when you look at performances and fees, it tells you, again, this is performed 16% year to date, 16% in 1 year, negative 2.66%. This is interesting, right? Over the last 3 years. So if you average it out, it's performed negative 2.66% average every year for the last 3 years. But for the last 5 years, it has performed 8% average. Okay. So it really is kind of like coming down to when you start investing is if it's 3 years ago, your money is down. But if you start 5 years ago, your money is up by 8% annually. And then if you start investing 10 years ago, then it is up almost 5% annually. It is significantly underperforming the market. This is something that you really want to look at when you research for portfolio composition and when you research for the 401k, because the 401k manager, unless you pay a lot of money to the 401k guys or a financial advisor, they don't know how much risk you want to be exposed to. If you put all of your money into the EuroPacific Growth Fund, then you're probably not going to grow as much as the S&P 500. But is it going to outperform the S&P 500 in the next 5 to 10 years? Nobody knows, right? So this is something that you have to kind of understand the risk and how much you want to be exposed. Those are the two key words, is that risk, exposure. How much risk and how much exposure you want to have from your money to the US stocks versus the international stocks. Since pension is out of the question for many of you, you have to take matters into your own hands and take control of your 401k investments. First, you have to increase your savings rate. And how much you invest now will determine how much of your investments will replace your current income. But if your timeline is a lot shorter, and you don't already have enough money in your nest eggs, then you might not have enough investments to replace your income. That's when you need to drastically increase your savings rate. You can always download my retirement calculator for free by visiting firesightshare.com/resources. Even if you have a pension plan, you still have to take your expenses into consideration. Are you going to have your mortgage paid off when you're retired? And are you going to relocate to another state or town that's not as expensive as where you live? And how much are you looking to pay your taxes and benefits during your retirement? So instead of looking at your 401k as a scam, try looking at it as a source of supplemental retirement income. Imagine having just $500,000 in your 401k, either tax-free or tax-deferred. That could be an extra $20,000 a year in retirement income to supplement your pension. A 401k is not the only retirement income source you could have. You can always check out my other videos about the Roth IRA, HSA, dividend investing, and early retirement planning. But now that we went through the downside of having a 401k, the upside of investing in your 401k still far outweighs just living on your Social Security or private pensions. Just take 10 minutes a day starting now to get to know your 401k mutual funds. Do some 401k calculations, and you'll find out how much a 401k could matter in your future.